All right. So we got into this a little bit the last time we were here, but talking about the actual thing we're selling when we sell KPI and visibility. And obviously, visibility is the emotional word for this because they want to know what is everyone doing? Where am I making money? Where am I losing money? Things like that. And actually, to sell this, which is a KPI dashboard and a cash flow forecast, is a series of things which involves a lot of people. So when we say cash flow forecast, we mean a full financial reporting package, which is made up of the group of forecasting, easy to hard code it and present it to a board, because a lot of companies have a board they have to present this to. This makes that simple. And the KPI dashboard is something you kind of sell along with it so that they can know all the detail around that. So this would be like, what are the top 10 most profitable companies that are their customers, right? This would be profitability by employee. If it's job costing, like construction or things like that, what are we breaking even on? What are we making money on? What are we not making money on? And once we have that information, then that's a smart CFO will look at it and go, oh, well, you're losing money on toilet paper and milk, but that's what we bring people to the grocery store. So we get it. We're expecting you to lose money, but we have to make sure we manage the loss lead. So we're okay with losing 5% or breaking even on milk and toilet paper. We're not okay with losing 20% on that, because then they figure out how much do we have to sell of packaged goods to be able to cover that, and it's huge. So even when you know this information, there's a decision. That entire line of reasoning I just talked about, we can't even have that discussion until we get here. Like, you don't know how much you're paying on toilet paper. And most people don't know those things, so they can't manage their loss leader. So then they say, oh, well, I know this thing is a really high margin. It may be on its face, but actually in that same store that you're talking about, it takes your staff 4 times as long to stock that, because there's some weird prep part of it that you don't see in the background. And so to get here, it starts with, you've got the entry of the transactions into the system. Yeah, these are entered into the system and they're classified, right? And now comes at the end of the month. So this is involved with transactions come through, payables, receivables, payrolls done. That's all done here. And that is a bookkeeper or a staff accountant, and as high up as an accounting manager. So the accounting manager lives between 2 things, right? Here's end of month close. So end of month close is the second piece in the chain of getting down to visibility. You've entered the transactions into the system. You've done all the day-to-day, week-to-week stuff. And now at the end of the month, the way this starts is you open up a balance sheet and you go from the top to the bottom. And the first item on the balance sheet is cash. And so what we're doing is we're pulling the bank statement from their bank, and we're using the system to say, of the transactions they entered into their system, how those match with the bank account, are those all right? Are there extraneous ones that were double entered? Are we missing things? This gets pretty complicated if you think about it just generally, but this is like a combination of accounting manager and controller, because there are all kinds of things. Here, when they do their bank reconciliation, it might be that their merchant processor batches, and it gives them 500 transactions for the day. And then they have to go add up all of those transactions to get to the number that shows up on their bank statement. So it gets deposited as $50,000, but actually it was all of these hundreds of transactions. So you can imagine if you have transactions mixed up, now all you have is a number. You have to go through your bank reconciliation. You have to guess which combination of numbers comes out to $50,000. So there's a million things in there that a staff accountant is not going to be capable of. In certain of these really difficult bank reconciliations, you're pulling out some of Gus's Excel documents, and you're trying to figure out what combination of these numbers is actually getting to the batching. And there's coding in there that you can do. It's easy in some companies and almost impossible in others. Now you have to go get the credit card statement and figure it out. Sometimes they have it, sometimes they don't. Depending on what bank you're in, they might have bank statements or they might not. There are certain regional banks that don't have it. That's item one on a balance sheet. You're going all the way to the bottom. In accounts receivable, which is what customers owe you, you're looking at the aging. Is it 30 days old? Is it 60 days old? Is it 90 days old? And why does that matter? Because later when you try to get a line of credit, it's based upon that aging. And so you can get 80, 90% of current receivables, but if it's 60 or 90 days, you might only get 30%, 20%. That shows the risk of your business. On and on and on. We won't get into every account, but all of those assets, hard fixed assets like computers, cars, they're depreciated over time. So you're tracking that. So you back up the whole balance sheet, you go every line item, go into all the transactions, make sure, is this the correct balance? How did we get here? They create a spreadsheet, and then they use that spreadsheet put into the close file. So you have a file probably in a shared drive, and it says the close for May. And then it has one justifying the balance of the cash, one justifying the AR aging, and so forth, all the way down. All the way down through liabilities, which is accounts payable, accrued, all kinds of accrued things, and then down to equity, where they have the cap table. And that is the place in the cap table where the end of year CPA ends up having to do most of the work, because most people's accountants are not capable of understanding retained earnings. We do. So even if someone says, oh, my accountant's doing the end of month close, they probably are not doing the end of year things in retained earnings. We say an end of month close, we mean tax and audit ready end of month close. And we justify this. And so we'll go into the system. We'll find out they have 2 years of data that hasn't been done correctly. We'll try to get all of that correct. There's a few ways of doing that. You can say, okay, we're going to do every month correct by itself, and that's going to be 15, 20 hours a month or more. Or we can say we started on June 1st, and so May 31st, whatever May ends, we're going to make sure those balances are right on that day, and then we're going to roll forward. So we do a bank reconciliation for the entire period. We take all of the bank statements, add them up, and try to do one giant close to make it faster, and then we roll forward correctly. So that's where an accounting manager / controller lives. That's really where those two play, because the accounting manager can do the vast majority of this work. A controller is really making sure this is correct. They're doing, after those balances are justified, the controller is probably adding in a monthly depreciation journal entry or all kinds of entries like that. Then after your books are clean, okay, on this last day of the month, they're clean, all the balances are justified, and they move on to the P&L just to make sure, things like, if I am the manager and I have a salary, I shouldn't be up in the hourly labor section, because the hourly labor is a direct cost. Say on the manufacturing floor, every hour I do results in income. Therefore, I'm a cost of goods sales. The manager is not. So we're doing all of those things. Balance sheet is clean. P&L makes sense. There's revenue recognition here. And that's kind of where the controller enters his zone, is JE, journal entry adjustments, revenue recognition, because you can't have a true close without all these items being done, and P&L slash general ledger scrub. This is,
So everything is right on point. I think you're split right there. I think where I see too, a county manager is also like more up to those daily transactions. Yeah, and then the controller again is down. Now, a county manager can live in that in the month, but more than likely your controller is probably more driving that in the month, and your county manager is doing that day to day, AP, AR. A good accounting manager that's on its way to being a controller is living in that in the month.
okay, that's a good point, because I use controllers in accounting manager roles mostly because I have trouble trusting accounting managers. So yes, I expect an accounting manager to do this. That is not common. We absolutely can get controller rates for an end of month close.
Yeah.
Yeah, this is like a fun term, general ledger scrub, that you can just use where every real accountant knows that you just are throwing some random term out. But it sounds really impressive to people who don't know what that is.
So the other thing too, I think that, and this I think is important. KPIs are so important, but KPIs are really specific to a company or a region. So sometimes people think KPIs and think all KPIs are the same. You can have a company that's in the same sector, but their KPIs can be different because of.
Ooh, that's gonna go here. We'll talk about that. So if you're noticing I'm going down, I'm gonna keep going down, but to get here, you involved all of the people we sell. So you get to an end of month close, and this is really the details of the final close, making sure this is all correct. How do we get here? So now you're looking back and you say, this is the month. Well, now you need to present that. You need to present that in a way that on your balance sheet, your P&L, it may be this long, and you're going to show it to the board of the CEO, and you need to crush that down. So we create a package, which is the actuals simplified plus our budget for the future. A lot of times we're saying, okay, we average about $1,200 a month on paying for recurring apps or something that we use in the business. We're just going to drag that forward, and we build kind of those averages, and then we go back to the company and we say, what do you know that we don't know? Oh, well, in 2 months we're implementing this huge software. It's going to be $250,000. We go update that. The actuals plus the budget allow us to create this cash flow forecast template. And that is where a controller ends. So they have, aha, I did a cash flow forecast with the budget. I did all of that. And there's one thing in between here and where the CFO starts. And that is scenario analysis. Okay, here's the budget. If we change the budget by X, would we have any cash left? So in this package, you have a P&L, a balance sheet, and a statement of cash flows. And that's known as a three statement report. That's what everyone talks about. I want a 3-statement report. Is those 3 things. And it's left here, and this is static. The CFO comes in and goes, okay, I see we have enough cash throughout the whole year. If I had to take on 2 huge jobs and spend 12% more on marketing, what would that do? They drop it into the rest of the year and they go, in April, we're going to be $200,000 short. So either I need to find $200,000 in cash or we can't do it. And now they have months and months to decide to do that. Going back down from the start, they think they want to know all the visibility here about the KPIs. Where am I making my money? Where am I not? Even before that, they might find out your plan is totally insane. You're gonna go $1 million negative on cash if you try to do your plan, even as you're saying it right now. This is not possible. Oh, it seems like it's possible if we get paid in all things. Yeah, but you're collecting your receivables on average at 55 days. So we say your receivables get collected 55 days, you're not gonna make it to payroll. And we can see that out based on their averages. So we went from entry into system, closing a month backwards correctly, and then showing that backwards correctly actuals, plus the budget, which is forwards. And that's what we talk about. A controller does everything backwards, and a CFO does everything forwards. So now this planning, modeling, scenario is where the CFO comes in. And finally, you have this package that's really clean and that you guys have watched Gus talk about. And now you get to KPI. So how do you do that? You have all the financial information that's flowed here. What gets brought in to do a KPI is like, they have all these other softwares. They have project management. They have a gamified competition like we have on Power BI, where you see who did enough NAM, who's doing quota. That's all built out into that. So we can show your quota based on how close you are to your quota. We can say, okay, we said we were going to spend $100,000 this year developing product A. And we are 6 months into it. We've already spent 98% of the budget. Were we intending to do it in 6 months, or are we out of budget and didn't make it? And those kind of things come into this KPI dashboard where we're saying customer profitability, profitability by employee, right, location, that's a lot of times. And then what products are making money, what aren't, and what are allowed to not make money. And that's where, if you try to put a controller in a situation where they have to look forward, if they're a true controller and they don't have that mind, accountants do not make it here. A pure accounting mind, if you throw this at them and you say, oh, this is all the same as accounting, you're going to have a meltdown. This person is not going to do this. They cannot figure out how to do this. This is not how they think. So this is where you go from accounting to finance. And you will see it if you're doing this long enough. There will eventually be a time where you think somebody's at a CFO level and you put them on, and they're actually just a controller and accountant, and you watch them in front of the customer, not even able to conceptualize what they're talking about. Yeah.
Like, about controller stuff is like, well, they want to roll up their sleeves and do the work. If that's not the position, CFO is the budget and the forecast and the strategy. Controller is gather. The CFO can't do the job without a controller.
Yeah.
The
And
controller is the most.
the most telling part from this, even if you didn't know anything about this, you could tell their jobs are different. A controller has his head down. He is working 40, 60 hours a week. He's always behind on everything. He's trying to get something done. A CFO, you go in his office, he's sitting there looking out the window. Why? Why is he? No, that's just a bad.
What do they call it? It's the art.
This time. So why is a controller working his butt off all these hours and trying to get the block and tackling, and a CFO is looking out the window? That is a totally different job. The controller has to get everything exactly right. He's super detail focused. He's trying to get what happened. He's the historian. This guy in the CFO, if he's doing that, he's a bad CFO. The CFO is mostly a thinking job. That's, you either have contacts who have capital to be able to get good lines of credit, or you're designing the accounting department to make sure you have a good controller, accounting manager, they come to you and they say, this process is broken, how do we fix it? And I go, do we fix it via new software or do we fix it via a new process? And I create that. If your CFO is really busy, he's not a CFO. Right? In public companies, your CFO doesn't do anything on accounting, basically. He shows up with the accounting records to go on television or to go on a call and just tell you what happened. And if you notice when you listen to public company calls, he'll say a statistic from the financials, but he's mostly saying, oh, loss reserves, which is some section on the balance sheet. He's just looking, loss reserves, we increased by 25%. And that's where a controller would end. But he goes on to say, and that's because we see significant risk in Puerto Rican, so-and-so bonds on the GO project or something like that. And that's where he's jumping off. So this has to be done to be a CFO. If you have to do all this work and be a CFO, it's a little like when you're sitting here and you're like, okay, I'm gonna type out this slide deck, I'm gonna get everything right. And you make everything perfect the way you're doing. And then you get on a call and everyone's looking and you finally step back and you go, oh, this is beautiful, but it has nothing to do with what the point we're trying to make. Like I got so focused on designing the slide deck, I realize now that this is totally irrelevant because this wasn't even the point we're trying to make. You can't be a detail person and a 10,000 foot person at the same time. And if you can, we'd love to hire you because that's one hell of a human being. I can do both separately. I can't do both at the same time. If I'm the one to write the book, then I won't catch my own spelling mistakes. Right. Period. Right. It's just not going to happen because I've looked at it too long to catch my own mistakes. So that's the difference. So now if you look at it, to get to the information a CEO and a CFO need to make to decide what to do with the future of the business, you need bookkeeping, staff accountant, accounting manager, and a controller. And then you need a CFO looking forward, presenting that to a CEO. Then the CEO and the CFO go, what does this mean? And decide, oh, well, actually, we're making a crazy amount of money on packaged goods, and we thought we were only losing money on toilet paper and milk, but actually, we're losing our ass in the deli department. So what should we do? Okay, I have three ideas. One, we lower the selection. So we don't have capicola and we only do the In-N-Out burger model. We have three meats, the most common meats that sell. We're not going to do pancetta for anyone. We're lowering our selection. The other way is, okay, well, we're a specialty grocery food store. We're going to analyze all the things sold in the meat department and figure out how to source it cheaper, right? So that's where the CFO lives. Do we source it cheaper? Do we lower selection? Do we increase selection? How do we solve this area of the business? If none of this happened before, the CFO is just looking out the window. Like, if that's where the CFO is only looking out the window because he has no data to make any decisions on. He's just not doing anything. So the difference between looking out the window, thinking about it, and not.
When you say looking out the window, also looking at what's
right.
going on.
Right. Looking at the future and thinking.
Yeah.
So you're sitting there if you're in accounting, and you guys haven't had this experience because you didn't go through accounting, your whole accounting life, you're getting whipped to do something faster, better, to complete something. And all of a sudden, someone puts you in a CFO job, and it's like, what the heck do I do?
And that's watching girls.
Yeah. Right. Because busy work drives how good an accountant you are. Busy work does not drive how good a CFO you are. Yeah. So then we talked about KPIs are different for every industry. That is really interesting. What we were talking about earlier on percentage of recurring revenue, right? And in percentage of recurring revenue, the things that drive that are the churn percentage. So when that last call for NowCap, we were saying 25% of the total clients they started out with for the year changed. So they had a 75% year over year capture, and they had and 25% of them churn year over year, right? Those are things that matter. When you're talking about project management, which is like construction, it might be one portion of a company that's developing a product. You're caring about the profitability by project. You're caring about percentage of completion. So there's two things that are percentage of completion. One drives the accounting portion, because now as soon as you figure out, hey, this is how complete a project is from the standpoint of start to finish, where are we at? This information feeds back into the end of month close, where they have to decide how to recognize revenue. But it also tells the CEO, we're halfway through the project and you spent 80% of the budget. We need to relook at this. So this is SaaS, pest control, anything really that is recurring in nature. So you have an app on your phone, can't figure out how to cancel it. They're making a crazy amount of, or they have a crazy valuation on the company because you can't figure out how to cancel that $12 a month. Yeah, that's what people are looking for. So there's the difference between that and construction, right? Service businesses, we're a service business, other consulting, property management, anything that's really service-based, you just think about what drives their business. What drives the business here are people getting out there and doing the work on pest, so that's really service. On SaaS, what drives it is your customers finding the experience useful and easy, so frictionless. So here you would spend a whole bunch of money making your user interface work flawlessly. Here you would spend a lot of money making sure your people on site are dressed well, showing up, using the right products. When you think about that on construction, it's how quickly your people and how efficiently they're building a house. On service, this is an incredibly people-based business. So while construction has to worry about some materials, am I going through hundreds of things of caulking because I keep messing it up and I've made the budget go crazy, or I ordered the wrong size windows, they didn't fit because I don't know how to do basic math. Like you start noticing, hey, crew 4 gets it done faster than everyone at a lower cost. Why is that? And you can start researching that. Those are the kind of KPIs. So this is usually done in crews, like you were talking about, by location or by crew. Crew 4 is the fastest and the cheapest. Why? Crew 6, I had this scenario just recently with a 1 week bath. So they're a company that they do your bathroom in 1 week. Pretty simple. But he was noticing, okay, my best crews, the one that do the highest quality work, they're 20% better work, but they're like 200% more costly and take the time. So he's like, I love that they do that high end work, but we're willing to give them 5% better than everyone else for maybe 3% more cost. We're going to lose our butt on that. We can't do everything perfect all the time. So business owners live in this world of being an obsessive compulsive person who wants to do things perfect and give value to their customers, but not capable of doing that under the cost, because the other company will say, we're identical, just trust us, we'll charge 20% less, and they just don't get the gig. So knowing which crew to say, guys, I love it. Your work product's the same. Back it off a little bit. Like, just bring it down a little bit and keep costs low. And those are the things that they need to live on. If we don't get to this, we don't have a customer, because this is meaningless. We talk about this a lot, and this is where we spend our time, but nobody gives a crap if we close their books right if they run a business. They're just going to look at their bank account and they're going to say, okay, I have enough cash to make it to the next payroll. until they get this data out of it, it's useless. And that's the thing that we have to realize. We're really down in the detail like the controller and believing in this process, but it is of no use to an end user if they can't make decisions on it, which is why we get to timely. Is it recent enough that I can make decisions on what happened? Or is it like I get my books closed 90 days later and I go, man, we probably shouldn't have done those jobs for the last 3 months. Guess we're going out of business. You know what I mean? Relevant, which is, okay, great. You told me that my RevRec system sucks. I don't care. How well am I doing from a profitability standpoint? That doesn't necessarily matter to me. How are my crews doing? Who's the kind of profitable customer? What kind of job should I be doing more of? Oh, I didn't know that recurring revenue would be valued higher as we were ready for a sale. So the CFO says, am I just running this to grow this for your family, or are we intending to sell it? Okay, we should move to recurring revenue because that's going to give you a higher valuation. And that's where we connect with Now Capital, obviously. But timely, relevant, right? And go through all of the things. We're just trying to get here because this is where the CFO can advise, they can teach, they can tailor. So you're trying to convince them that they need visibility, and you need to understand when you say visibility, you mean down here. But to get there, we need all these steps. And so you say, you need visibility, you're flailing your business and you want to know why. I'm going to get that for you. We need these people to get clarity on what you did in the past, to get likelihood of what you're going to do in the future. And then we need someone to make the decision. So this is the staff accountant, gives you the staff account all the way to the controller, gives you clarity on what you did in the past. The CFO and the controller decide what's reasonable to do in the future, and the CEO and the CFO decide what to do about the information. And that is visibility. Any questions on this that we can jump off on? Like, we can keep it high level. I tried to keep most of this high level, but
So companies don't have CFOs, how are they really prepared? Like, how are they looking forward?
a lot of times
They have,
the owner is saying, well, I used to do this myself, and so I know that this is not very profitable. And I only have 2 crews, so I can go check up on Jimmy and his 3 guys, and it's fine. And the point where they call us is usually, oh crap, now I have 5 crews and I can't check up on all 5 of them the same week in a meaningful way. And we start to use data for him to check up. Yeah. So the telling thing, like Jim, if you were to ask him, hey, you were to ask him about some engagement that you're on, right? Jim would go, I don't know about any of the engagements we're doing, because he used to be the only consultant, and then he was managing a group at director level, then he was managing a group that were managing a group, and as he got further and further away, he was relying entirely on data out of Power BI to know, okay, I don't know about Joe's tire shop, but I do know that we had good utilization and we'll be able to make payroll. Right? And that's how they step back. And so sometimes early on in their business, we're trying to say, hey, you only have 2 crews now and you can visit them every week, but you want to grow to 5. You're going to run into this problem. Let's start now. So you don't have 3 months where you're losing money because you don't realize that 1 crew is just drinking beer on the roof all day. Right. Yeah.
nothing wrong with drinking beer.
Yeah. We want to be drinking beer on the roof all day, not our crew.
Yes. Yes. Yes.
I can't pause it right now. It says you cannot minimize. Okay, I don't want to minimize it. Yeah,